Hey friends, great to have you back here for lesson 6 of the StockAbility Startup. Over the time that I've been involved in the markets, I've lost count of the amount of people who've asked me, do I follow the news? How do I keep on top of all of the economic data, all the newspapers, all the analytics and so on? And the simple answer is, I don't. And they look at me and go, well, how? How can you be involved in the market if you're not looking at the right information? Well, it all comes down to a very, very important subject: perception versus reality. Check this one out and it will make sense, I promise you.
I think we would all agree that the world we live in today is a very different world to how it was 20, 30 years ago. Today, it is a world full of information overload, a minefield of data, opinions, analytics, rumours, whispers, and some information is directly misleading and some can be used to our advantage. The trader needs to know how to decipher the clues. We have to be really careful to make sure that the things we pay attention to in the news are actually going to help us, not hinder us and take us way off the beaten track. And it can be very, very challenging because a lot of people think the more information, the better. I come from a school of thought of less is more. The more information, the harder it can be to make an actual objective decision. And notice what I just said there, objective decision. One of the questions I get asked a lot is, what really moves the market? Well, to answer that, there are many factors which potentially impact prices in the marketplace, but to follow them all, it's an impossible task. I mean, let's just look at a few of the popular ones. Every single day, every week, we have economic data, inflation, GDP, house price sales, durable goods orders, bonds. Then we have quarterly company earnings. If you read most investment digests, they will say that earnings are the most important thing that anybody can focus on the stock. But how often have you seen great earnings on a company and then the market's done the complete opposite? We have commodity prices, gold, oil, silver, natural gas. Interest rates are always the talk. Is the Fed raising rates, lowering rates? What's the Bank of England doing? What's the Reserve Bank of Australia doing? An awful lot of information for people to keep track of. You get those announcements from the central banks, we get upgrades, downgrades on stocks, major analyst opinions from the big institutions, and then really massive world events like recently COVID-19 as well. So much going on and such a difficult task for a trader to be able to follow all of these things. And herein lies the danger, you see. If you look at all this information, we have to say to ourselves, well, what of this information is true and what is false? I mean, so much of it is down to opinion, guys. And, there's so much misleading, conflicting kind of direction in this. It makes it very, very challenging. And one of the big mistakes I see a lot of amateurs make is they rely too much on the news because they think it's the news that drives the market. But then how often have you seen this? All this kind of news comes out, you try to digest it all and it's being thrown in your face on your iPad, your iPhone, through the TV, through your newspaper, and then what do? All this news typically creates thoughts and a perception of what's happening in the world and of what's going to happen in the market. So then we rush to our phones, we rush to our computer, we check it out and we say, hey, this should make the market go up or this is going to make the market go down. The amateur then typically reacts and jumps into a trade based on what they think is going to happen next in the market due to that perception that the news has created. Now they're watching the market, they're thinking, hey, the news is good, the market's going to go up, and then what happens? The trade does the opposite to the news, and they're left scratching their head. Hey, this company just came out with great earnings and the market's tanked. What's going on? What do the big players know that I don't? And as the loss gets worse and worse and worse, the reality kicks in and the amateur takes a loss and then the cycle begins all over again because now they go back to the news trying to decipher the clues of, well, why did the market do the opposite to what the news said? And the cycle just goes on and on and on and on. I guess the question here is, what is the perception and what is the reality? Well, the reality, like I said before, is that nobody can follow every single piece of news. And I always break it down to its simplest, lowest common denominator. If the news really gave us the answers, then everyone would read it. I mean, I say this, if all of the information, if all of the analytics, the upgrades, the downgrades that the Wall Street Journal and CNBC and all these different television and news sources gave us was good, then everybody would just read that stuff, watch that stuff and make more money than they knew what to do with. But that's the problem. People don't. And they find a lot of conflicting outcomes from the information they provide and then the impact it actually has on the market itself. Well, to help us understand this better and to cut through all this grey area, let's explore the concept of value and price. Value? Price? What's the difference between the two? Well, most market speculators don't even recognize there is a difference between value and price. The educated trader, however, understands the major difference between the two. They've been taught to say, well, value is one thing and price is something very different. Let me explain. I think in simplest terms, we could look at value as something that's subjective, i.e. it's based on an opinion. Whereas price itself is more based on objectivity. It is what it is. It's either night or day, sun or rain. Again, there is no confusion in it. You see, if we take value as a concept, value typically comes from somebody's opinion, and an opinion can be emotional. An opinion can also be biased. The question is, does the market share that opinion? You see, you could have value for something because you like it. You could say, hey, I'm going to go buy Nike stock because their sneakers are the most comfortable ones in the world. Well, that doesn't mean everybody else agrees with you and that the stock's going to go up. But here's the other thing. If Nike's at a historical low with a very cheap entry price and a very low risk and a great reward, objectively, it could be a good opportunity. Are you starting to see the difference here? And that doesn't matter whether you like Nike or Under Armour. Who cares? It's about objective opportunity, because when it comes to price truly is objective. The prices can either be high, the prices can be low, the prices can be fair valued. But the price is the only truth. And one of my very first mentors explained this to me early on in the day. They said, Sam, price is the only truth. Focus on that. When we look at it in this particular example here, it's like a scale of balance. Objectivity will always win for me over subjectivity. Objectivity is neutral. Subjectivity is emotional. Let's look at an example here. This is a really recent one. Some of you may have read about this in the press only recently. A Tesla case study. I pulled this news from the BBC News website on here. You may have read in the news, this was on May 1st, Elon Musk tweeted that he thought his company's shares were hugely overvalued. This was on May 1st of this year. The headlines read, Tesla boss Elon Musk wipes $14 billion off the car maker's value after tweeting its share price was too high. He said, Tesla stock price too high in my opinion, on one of several tweets that included a vow to sell his possessions. Well, how many people do you think read that news and went, oh my God, this is bad. I got to sell my Tesla stake. Well, let's go over to the chart and see what that looked like here. On that same day when Mr. Musk made that tweet, what did the stock market do? It collapsed. We saw a pretty sharp sell-off of 21% in the stock price at that particular time. Did the market fall on perception of bad news? Maybe. But then what did the market do after everybody panicked and sold? What did the market then do? It went on to rally for the next 3 weeks. And on that bad news, recovered all of the losses that it had made practically. And the last time I checked, it's actually higher right now. The bad news caused a rally. The reality kicks in. Was that initial sell-off due to the bad news? Or was it just a knee-jerk reaction where the professional trader said, hey, this market's 21% cheaper and I could buy it at a bargain price? Think about that. Someone's always going to be on the right side of the news. Somebody's always going to be on the bad side of the news. You have to understand the difference between the two. And to do that, it's all about understanding the difference between perception and reality. My advice is learn to trade what you see, not what you think. What you think doesn't matter. What you see is what's important. Value is always going to be a perception. Price is always going to be the reality.
So after that, you're starting to probably understand why I'm not a news junkie. Price, first and foremost, is the most important thing that a trader and even an investor really needs to focus on when making a decision. Remember that, and you'll definitely be giving yourself a much better probability of being on the right side of the market more often than not. So we're coming up now to our final lesson. Lesson 7, we're going to probably do things a little bit differently. This one is going to be entitled Sharpening Your Mental Edge. Grab your couch, sit back, and let's talk a little bit about that when I see you next time. Take care.